The problem that you're facing when you have an early retirement is you have a long lifespan. So you are planning for your money to last a very long time, and inflation is going to be your biggest enemy. So the first thing we had to do is figure out, okay, is your money going to outlast you, or are you going to outlast your money?
So I'm curious. I mean, the reason that they contacted us, my recollection is because the husband was thinking about retiring, correct? Like it was time for him to like say, I'm going to live off the land.
Yep.
And I probably need someone else to look at this to see if I'm on track.
Correct. And a majority of their money is in a retirement plan at work. So they didn't have somebody who was managing their money or necessarily to plan with their money. And they were saying, well, this is probably a good time that we make sure our money is actually working for us and going to meet our goals.
So based on your initial analysis, Court, were they positioned so that their money would be in a position where they won't outlive their money, or was their money going to outlive them?
So they luckily in a really good position where we said you can get a pretty conservative rate of return. Like even at a 5% rate of return, they will have more interest, more dividends, and more growth than they need, which means they can have a conservative portfolio and their money is only going to grow throughout their lifetime. But then what I did is I looked to take a look at their investments. And do you guys want to guess how aggressive or conservative they were?
Well, I'm looking at the case I'm looking at the proposal put together, and they're 80% in the market. Now,
they are 92% in the market, right?
They're 92% at risk in the markets, which, that's great when you're 20. You don't have to worry about your portfolio for a long time. And we see a lot of that right now, right? That baby boomers, they're getting into their late 50s, early 60s, 70s, and their portfolios are positioned like they're 25. Now, great when the market's going up, but we know if you're 92% equity, man, oh man, your downside risk is tremendous.
Exactly. And that's what you want to look at, is saying, okay, if you can get a conservative rate of return, your money is going to last throughout your lifetime. This is probably a good time to reposition, because otherwise what can happen is you stay 92% equities, there's a big downturn in the markets, you're down 40 to 50%. That can actually affect your retirement and cause you to go back to work. And that's not what we're trying to accomplish here.
And I think if you just look at it logically, you think, well, markets go down, but they always recover. But I don't think most folks understand when you are retired and you're no longer having that paycheck come in, that safety net, that you now have to pay your bills with relative performance. When the market's going down, when you're retired, it doesn't seem like it will ever recover. And it's almost impossible not to panic in that scenario. And I've seen that happen. We had that in 2000 and 2008, where we had clients who wouldn't listen to what we had to say, fired us, ended up, going somewhere else. And then a year or two later, come back knocking on the door saying, well, we only have half left. Could you take us back and put your plan back together? I mean, it's funny, but it's sad. It's so sad.
It reminds me of that Mike Tyson quote, everyone has a plan to get punched in the face. And I think,
oh, yeah.
but I think what's interesting about this case, and I think this is very indicative of a lot of people right now, is until we put all their assets on one place on a spreadsheet so they could see their allocation, the husband, he didn't even really know that they had this kind of risk. And I think most of us don't realize it's not until we see where our 401ks are, our brokerage accounts are, and how they're all allocated together that you can really get an idea where your risk is. Because I think most people, it's not intentional that they have that much risk. They just don't know it.
So, Court, they did have 92% in risk assets, equities, basically, but they did have 8% in cash. Now, was that, were they thinking they didn't want to invest in bonds, or that, money market rates were 5% or 4%, that they didn't need to lock in those rates? What was the thinking?
Well, they did. I think what adds up too, right? You say 8% in cash, but that was $200,000 in this case for this.
$250,000.
Yeah, that's real money. And again, it's like, I think a lot of times you're not aware of it because maybe you have a little bit of cash in this account. You have a little bit of cash in that account. And it adds up, and all of a sudden you have hundreds of thousands of dollars sitting in cash accounts. And that becomes a problem when the Fed's been cutting interest rates and your money market fund went from 5%. Now it's under 4%. It could be closer to 3% by the end of the year. And this is where putting your head in the sand and not addressing these issues has a major impact negatively on growing your money long-term. And most of us just aren't addressing it.
And I think these are problems that a lot of people face, where you are really good about saving your money. You're putting money into your retirement plan at work, but then you don't think about it, right? So you're putting it in there. It's getting invested for you, but you haven't looked at it in years. So you're still invested like you were when you were 20. There's still some cash accumulating. You don't realize how much it is, but it's not something I think anybody should be faulted for. It's just like you do need to look at this, have somebody do a review, especially every few years. Make sure, are your goals still the same they were 5 or 10 years ago, or should you be making changes to your portfolio? I would say probably most people should be, but it's easy to just not look at it, just set it and forget it. And I think that's what happens in a lot of cases.
Yeah, I think it's happening a lot because you see trillions of dollars still sitting in a money market fund, while interest rates are dropping like a rock. I mean, a 3-year treasury now is under 4%. The money market funds are all under 4%. If you're sitting at a bank, they're only paying you 1/10 of 1%. So, no harm, no foul there, right? The banks don't have to pay any interest.
Yeah, and the other thing too is what I love watching when you do this analysis, we show you how much cash flow could you be generating on your money. As Chris likes to say, who's out sailing right now, is you get a better outcome with income. And what I love about this portfolio is by re-diversifying it, better spreading the money out, taking less risk, you're able to increase the income by like a pretty sizable amount.
Exactly. Yeah. So I'm looking at the analysis we ran, and they're currently generating about $44,000 a year between interest and dividends. And just by reallocating this portfolio, making sure it meets their goals, we're able to increase that to more like $94,000 per year. That's an extra $50,000 of income that you're getting, which means you don't need the stock markets to go up a single dollar. You're just generating that every year. And especially a client like this who doesn't need the money, we're just reinvesting that and buying more investments every single year for you so that down the line when you need it, you have more that's growing.
Well, I'll tell you one thing. I know you're not going to recommend, Court, as you've been repositioning its portfolio, is this annuity we just transferred in from one of our existing clients, where after 18 years of taking risk in this guaranteed investment, what would you guys guess was their annual average rate of return?
Usually low on annuity. I'd guess what, 2%?
Wow.
Yeah.
Courtney, it can't be lower than 2%.
How about 0.2%? I mean,
Jesus.
barely made any money net of the fees from the insurance company. 18 years, they had $200,000 that, with a conservative balanced portfolio would be $500,000-$600,000.
Do we think the insurance company is taking a lot of fees out of that? I wonder. But they say there are no fees. I don't get it. And I think that's the wild opportunity right now, right? Is by just allocating your portfolio to liquid assets, because annuity, once you turn that income stream on, it's not liquid, is you can generate a huge stream of income right now by having, real estate in your portfolio, having real estate investment trusts in your portfolio, having energy pipelines in your portfolio, having a global portfolio where the yields are higher. There's just so much value in having diversified sources of income, and you can do that with a liquid portfolio where you don't have to lock your money up. It just drives me crazy.